When the opening bell rings, it triggers a massive influx of institutional and retail orders all at once. For the first 15 to 30 minutes, the market is defined by high volume and erratic, non-directional price swings. This is where the fear of missing out takes hold. Seeing a sharp move upward, many traders buy in immediately, hoping to catch a trend before it leaves them behind. But often, these moves are engineered liquidity grabs. Large players may push the price just far enough to trigger retail buy orders, creating the necessary volume for them to sell their own large positions at a better price. When that happens, the breakout reverses instantly, leaving the initial buyers trapped in a losing trade. To survive this window, you have to ignore the impulse to react. Success at the open requires treating the chart as an active, unpredictable environment, where every move is unverified until proven otherwise. The first rule is mandatory: do not trade. For the first 15 minutes, your only job is to observe the price and let the initial volatility settle into a readable structure. On this chart, we identify the absolute highest point the price reached during that 15-minute window and the absolute lowest point. By drawing these lines, you contain the morning's chaos. You've established a strict perimeter, and anything inside these lines is considered market noise. This process shifts your role from a reactive participant to a detached observer. You aren't chasing the price anymore. You are waiting for it to cross a specific predefined trigger. The situation changes the moment the price decisively breaches one of your perimeter lines. This is the potential breakout, but on its own, it isn't enough to justify an entry. To enter safely, you need confluence. This is the alignment of multiple independent technical signals that all point toward the same conclusion, that institutional money is actually backing this move. The first evidence is volume. If price breaks the high line while volume remains flat, it's likely deceptive. A valid breakout requires a corresponding volume spike, typically 20 to 30% above average, proving buyers are committing capital. Next, check the historical record. If the breakout occurs at a major resistance point from previous days, the move is reinforced by institutional interest. A breakout that lacks high volume or historical support is statistically likely to fail. Without corroborating signals, the move is just a trap. One of the most common ways to get caught in a false breakout is by acting on a wick. A wick is a temporary shadow on the candle that shows where the price touched but failed to stay. To confirm the move, you must wait for a full-body candle to close entirely outside the range, signifying it held the new level. Look at earlier attempts in the center. The wicks pushed through the boundary, but candles closed inside. That is a failed breakout. Only the solid green candle on the right represents a successful breach. When that full candle closes outside the perimeter and your volume and historical levels align, your initial hypothesis is supported by data. Requiring this final close is what filters out the noise. It is the difference between consistent execution and simple guesswork. Even with multiple layers of confirmation, the market can still behave unpredictably. No strategy provides 100% certainty. Your stop loss must be placed immediately outside the opening range. For a long trade, that's right below the low. If price reverses and crosses that boundary, the logic is gone. The stop loss takes you out automatically, preventing a major loss. By combining the opening range, volume verification, and strict stop loss rules, you remove emotion from the decision. You replace impulse with a systematic, evidence-based process. You have the rules. Let's see if you can apply them. Question 1. The market opens and the price moves instantly. What do you do first? You wait 15 minutes and mark your high and low boundaries. Question 2. The price breaks the high of the range, but volume is lower than the daily average. Is this an entry signal? No. Low volume indicates a false breakout. Question 3. You enter a long trade on a confirmed breakout. Where does the stop loss go? Just below the low of the opening range. The market will always try to bait you into an impulsive decision. Don't take the trade until the evidence confirms the move.